Greetings, everyone. Welcome to Cutting Through the Noise, our monthly investment webcast. I'm Samantha Geyer, Marketing and Communications Manager at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little about Tony and our firm. Tony is a partner and chief investment officer at SignatureFD. His curiosity and study of market history and portfolio construction led to a career spanning more than 15 years. He chairs SignatureFD's investment committee, represents SignatureFD at industry events, and has authored articles for the Wall Street Journal, Barron's, the Financial Times, and other industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth, their time, resources, and relationships to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. This holistic approach to wealth management is something we like to call net worthwhile. If you're interested in learning more about how we can help you activate your wealth and start your journey toward your net worthwhile, please visit signaturefd.com/blueprint after the presentation and take our short online quiz. And with that, I'll turn it over to Tony to get us started.
Great. Thanks for that introduction, Samantha. So let's go ahead and dive right in, and we'll start with the conclusion first, as we kind of always do in these monthly updates, and then hopefully we'll provide some supporting evidence afterwards. So first and foremost, I don't think many people would use the word normal and this pandemic economic cycle in the same sentence. But the market cycle has actually been quite normal, and we think we're in a phase of the cycle that you would call an echo bull market. So we're going to spend some time describing that and talking about implications and what that means. Now, the market has been much more discerning this year with very clear leadership from some of the large cap stocks. And we'll talk about why that type of bifurcation may continue and how that may be frustrating to seasoned investors, particularly professional investors. And finally, this recovery hasn't been perfect, and there are some cracks, but it doesn't look like a recession is imminent. And that's important because we think that this bull market may last until the next economic downturn gets here. So let's start with this first slide today. And out of all the slides in today's webcast that we're going to talk about, we're probably going to spend the most time here on this one. This is a stylized illustration of how the stock market cycle, which we can see in the top clip here, how that tends to run with the economic and the earnings cycle, which is shown in the bottom clip. Now, typically what you get is you get a bear market, which is pretty severe, and that tends to coincide with a recession. Now, we had that in 2020 during the pandemic shutdown, but then that bear, those sharp, severe recessionary bear markets, those tend to be followed by a very strong bull market, which foreshadows a rapid rebound in the economy. Now, we had those conditions from mid-2020 through 2021. But then note how the trajectory of the economic recovery tends to downshift after that initial strong rebound. Now, that downshift in growth, what that gives us is it gives us a bit of a growth scare, and you get kind of this fear that there's a double dip recession on the way. And in line with that growth scare, the stock markets tended to experience a more shallow second bear market. Now, our friends at Ned Davis Research, they call those bear markets, they call those echo bear markets. So if you hear me refer to an echo bear market, that's what I'm talking about. And that's what happened last year in 2022. And finally, once investors realize that growth is still okay, the market experiences a pretty strong recovery, which we had beginning in October here of last year, and that eventually settles into a slower but more sustainable bull market advance. And that is where we think we are in the cycle today. Okay, so let's put some numbers into what these bears and bulls kind of look like from a number perspective. Now, I don't want you to focus on every single number in this table. Rather, what we're going to do is we're going to look at the bottom rows. Those are the medians for each of these pieces of the stock market cycle. Now, in recessionary bears, the stock market has tended to drop about 33% over roughly a year and a half. Now, the COVID decline was less from a time perspective, but it was a 37% drawdown or so, and that was in line with the drawdown that you would normally experience in a recessionary bear market. Now, the post-recession bull on median has seen a return of 71% over about the same time frame that the bear played out. Then you kind of get that follow-up echo bear market. And that's only been down about 18% over about 2/3 of a year. So obviously a lot less severe of a bear market than that recessionary bear. Last year's decline was in that ballpark. And then finally, the follow-up bull market has returned about the same on a total return basis as that post-recessionary bull market, but it's done so over almost double the time. So the upshot there is that your annualized returns are lower, but still quite respectable in that type of bull market. Now, depending on the nature of the bull market and the economic cycle, there are some implications for investors. When you're rebounding from a recession and economic growth is roaring back, that's tended to be a great environment for small cap stocks. So here in this chart, what we're showing is the performance of large caps in black and small caps in red, starting around all recession end dates. Now, notice that small caps are typically quite strong and tend to outperform large caps coming off a recessionary low. So we want to overweight small caps following a recession. But what about in a bull market like we have today, one that's coming off of more of a growth scare and not necessarily a recession? Well, we ran some numbers around that and we feature it in this chart here. So this is showing small caps relative to large caps. And what you can see is when the line is falling, that means that small caps are underperforming large caps. And when the line is rising, that means they're outperforming. Now, the dashed vertical line here represents the end date of all echo bear markets. Now, recall, those are those bear markets that were associated with a growth scare and not an actual recession. Now, on median, small caps underperformed during the bear market, and then coming out of it, they're pretty flat. In several of the individual cases that we looked at, small caps actually underperformed large caps in the bull market, in this type of bull market cycle. So one other implication of this is that market breadth tends to be much weaker in an echo bull market than in a post-recession bull market. So you may have heard analysts out there that have been concerned that only a small handful of stocks, a small handful of companies are carrying this market advance. And the first point we'd make about that is that's simply not true. There's been more stocks going up than just a small handful of them. And the second point we'd make is that not every stock goes higher in this type of bull market. The market tends to be more discerning and has sometimes been more favorable to large caps. Now, one implication of so-called poor market breadth, and all we're talking about when we say market breadth, is the percentage of stocks that are advancing. And one implication of poor market breadth is that professional investors have a tendency to be distrustful of the advance. So here I'm showing hedge fund positioning in stocks. Notice how hedge funds remain net short of the stock market despite the advance we've seen thus far. So two reasons for this is, first, potential economic growth in the US is really only 1.8 to 2%. So if we've downshifted economic growth to be in line with potential, that's not a really strong growth rate. And that means that some cracks can form along the way. And then second, high conviction technical indicators that a lot of these folks may be using, they've got a tough time getting very bullish when small cap stocks are relatively weak. So we suspect that this bull market may frustrate professional investors and could do so for a while. Now, other instances of post-echo bull markets show that these advances can often be pretty low volatility. So here in the bottom of this chart, what we're showing is the VIX index, which tends to spike when markets are volatile. Now, note that in the mid-2000s, the mid-2010s, and from 2016 through 2017, volatility was low, and it stayed low for a while. So why is this frustrating? Well, a lot of investors remain well overweight cash and underweight stocks. They might be looking for an opportunity to deploy that cash into stocks if you were to get a major pullback or some sort of high volatility phase. But if history is a guide, they may not get that chance for some time. Now, we think this bull market will take us about as far as the economy does. Eventually, the economy will succumb to its next recession. So when can we expect that next recession? Well, let's talk through that a little bit. And if we look at purely traditional leading indicators, they say we should be in a recession already. This chart here is showing the index of leading economic indicators from the Conference Board, and that's plotted in orange in the bottom clip. And it's been in a zone that's been consistent with recession since June last year. Now, weighing on leading indicators are things like the yield curve, consumer expectations, and new orders. And on new orders, that's been particularly true in the manufacturing sector. Now, this chart here shows the historical cycle for new orders in manufacturing. And note that there's a pretty clear pattern of about 18 months of strong ordering and 18 months of weakness in manufacturing orders. This follows a business cycle where businesses do inventory stocking and destocking. Now, we're clearly on the destocking side of this cycle. Now, some of this has been a little unique to COVID. Companies were well understocked in 2020, and they spent time rebuilding those inventories through 2021. They've been working those down for a little while now. And we suspect that this trend here may start to move the other way as the year progresses and inventory finds its equilibrium. Now, a turn higher in new orders, that would be good news for economic growth. And so would a trend of stronger private investment. So here in this chart, we're showing the Atlanta Fed's estimate of private investment for the second quarter. Private investment has been a headwind for economic growth for over a year now. But we've seen residential investment turn higher lately as home builders are picking up the pace of their housing starts. And as we'll show in the next chart, there's something of a boom occurring in manufacturing related to investment. Now, on the left side of this chart, and I would pay attention to this chart, this is not something that you're going to be getting a lot of in the mainstream media. But on the left side of this chart, we're showing manufacturing construction spending. It's been in an absolute boom. It's absolutely shot higher. A large percentage of this spend is on technology. Now, several things are going on here to create this surge in investment. First, there's integration of AI. So AI has been all the rage and companies are spending on it. Second, we have reshoring activity. And third, we have government behind it with multiple bipartisan bills passed in the last year or two to support tech spending. So there are good reasons to be optimistic about economic growth that you probably aren't going to hear a lot about every day. Now, as it pertains to corporate fundamentals, one trend reversal we're keeping an eye on is on profit margins. Now, in the top clip of this chart, we show S&P 500 profit margins. In other words, that is how much of a company's sales makes it down to their earnings. Then in the bottom clip, we're showing the difference between consumer inflation and producer prices. Interestingly, input costs were generally rising a lot faster than consumer prices last year. And what that means is that companies couldn't fully pass through their costs and profit margins were shrinking. But today, we're up here in this zone where input costs have moderated strongly. So corporate profit margins should stabilize and maybe even improve throughout the rest of the year. So why is that important? Well, if margins are stable, then more revenue growth will make it down to the bottom line. Sales growth correlates strongly with economic growth. So if the expansion continues, we would expect earnings to improve throughout the rest of this year. That fundamental improvement in earnings, that could provide support for the sustainability of the market advance. So don't listen to folks that are the pundits on TV that are telling you that there's nothing fundamental underpinning this rally. Okay, so to recap, this feels like a very abnormal cycle, and in many ways it has been, but in other ways it's been quite traditional. So we think we're in a bull market, and that it's an advance that's could potentially frustrate many professional investors and the like, and really anyone that's been fearful of the market. Those characteristics, those are going to help to hold up this so-called wall of worry that the market can climb. Now, we think that this cycle will take us about as long as the economy does. And despite some leading indicators that say we should have already been in a recession, we still continue to think that expansion can continue for some very good reasons. There's reason for optimism in upcoming quarters. Okay, guys, so with that, here are the disclosures for the month. And I don't see any submitted questions throughout the presentation. If you do have any questions, you can feel free to email me directly at tony.welch@signaturefd.com, and we'll be happy to get back to you. Thank you for tuning in.